All right, what's up, everyone? Welcome back to Don't Rest Until You Invest. So this week is a little bit interesting. I was not planning on making a video about this subject, but with new events coming in this week, I felt obligated to make this video. And what I'm going to be talking about is the coronavirus. Whether or not you should be investing in the stock market during this coronavirus. Yes, it is very horrible. I sympathize with the people that are losing loved ones. I also sympathize with those that have, caught the sickness, and, I hope for you guys that it doesn't happen to you or anyone that you care about. So again, my prayers are with you. But let's get on to the subject of the stock market. I mean, it has bombed. Like it's just been going through the floor. And, guys, please stick to the end of this video, because what we're going to be talking about is we're going to be talking about whether or not you should invest in the stock market, number one, at this time. Number two is we're going to talk about, if you are going to invest, what should you invest in? And number three is, depending on what type of investor you are, what strategy you should take to doing that. All right, so just stick to the end of the video. So anyway, let's get into whether or not you should invest during this time, during the coronavirus. Well, I think in order to answer that question, we really have to define what the risks are. All right. So when the market is at its all-time high and everyone's making money, you got to understand at that point the risk is the highest it's ever been. Like when the market is hitting new highs, that is when the risk is the highest. Now, the reason why I say that is to say this. So the market's falling right now. And a lot of that risk that has been inherent in this market, in this bull market, by the way, which is the longest bull market we've been in history, a lot of that risk is being taken out right now. In a sense, we're kind of shedding the fat. So the reason why I really explain it that way is because you have to understand that the most risk is when you're at the highest level. When you come down to the bottom level and you let's say like during the 2008 market crash, right, where the market lost almost about 40% of its value, you got to understand that now built in, you are at the bottom. You have more ahead or above you than you do below you. All right. The other thing that you got to understand is, depending on your strategy, I mean, you're not going to go to zero. All right. What you're having is a paper loss. It's not an actual loss. You're just having a paper loss, and it really depends on your strategy. So first of all, let's get into whether or not you should invest in this market. All right. Now that I already described some of the risks. Yes, you should get into the market. All right. The market's on sale, man. Like, you need to get into the market. I'm not saying to go 100% into the market. That's just not smart. All right. So if you have money set aside in order to invest in your savings and stuff like that, you take a portion of it and put it in. I think right now the market, I'm looking at the TV, the market's down about 14% right now, 13 to 14%. So what you want to do is, as this market slides further and further down, you want to incrementally put more into the market. So what I mean by that is if you take 5% of your total savings, put a little bit of it in the market, right? Right now we're at a 14% drop. When it hits a 20% drop, put a little bit more. When it hits 30% drop, put some more. 40% drop, even more. Because you got to understand that we're shedding the fat. That risk, it's coming out. It's coming out of the market. Like I said, think about it. Think about it again, right? Where do you have more risk, the bottom or the top? At the top, you have more room to fall, aka lose money. At the bottom, you have more to gain, aka make money. All right? So you got to understand that. So yes, this is the time to invest, but not all at once. Because the reason why this is important not to do it all at once is because if you put your money in when it's down 14%, let's say, and then it drops to 20, 30, 40, 50, from the point of entry that you got in, 100% of your savings, let's say you put 100% of your savings in because you're just that enthusiastic. You got to understand that from the 10% to the 30%, that's still a 20% loss. That's still a 20% loss. That's still significant, right? But the reason why I say to do it incrementally is because if you do part of your savings or part of the money that you've put aside for investing, and you do it at 10%, and then at 20%, and then at 30%, and you do it in a proportional, strategic way, you're mitigating a lot of your risk from investing too soon. Because there is such a thing as investing too soon in the market when you try to time it. That's why they always say, a lot of the experts say, don't try to time the market. They're not saying not to take advantage of opportunity. What they're saying is to not go all in and put all your eggs in this basket of it being down 10%, because it could go further. Save some of your investing potential and ability and your liquidity for more losses. All right. The second thing is I was gonna talk to you about what you shouldn't be investing in. All right. So obviously, there's people out there that invest in individual stocks. There's people that invest in options. There's people that do technical trading. There's people that are long-term investors that invest in their 401ks or index funds. Now we got to talk about each one of those. So first of all, let's talk about those people that are doing technical trading. All right. So if you're a technical trader, obviously you already know you're looking for patterns and you're looking for advantages in these patterns in the markets so that you can make money based off of a specific trend. All right. Obviously, the trend right now is the market is falling. So if you're going to be a trader, which I'm not really into the whole technical trading thing, but obviously you guys already know that this would be a really good time to start shorting some stocks. But the one thing I would, be careful about is how much you're trading on margin, because that can really get you into a lot of trouble, especially if this market does bounce back, which eventually at some point it will. The next thing is if you're doing options, same thing. Be careful what how much margin you're doing. Also, it's very easy to get into a sticky situation because you're using a lot of leverage with options. The next thing is if you're a long-term investor and you have a 401k, really there's nothing you need to do. I mean, really, if you're in a target date fund, they're going to take care of things for you. Just maybe if anything, what you could do is if you have your 401k set up in a target date fund, maybe you can start contributing a little bit more during this time, because maybe this recession, maybe we'll go into a recession. It'll last a little bit longer. And at this time from your employee, you want to contribute a little bit more. That would be a good idea. The other thing is index funds, right? So this is my recommendation. My recommendation is to go ahead and invest in an index fund like the S&P 500, the total market index. Another thing you can invest in is in the emerging markets and the Russell 2000, like small caps. Okay. The reason why I personally like the index funds is because your risk is really spread out across the whole market. Like, you got to understand, in the S&P 500, you own the top 500 companies. If one of those companies go out of business, the next biggest company is going to go ahead and replace that. So you're always going to hold the top 500. There's very little turnover in it, and you're heavily diversified. And it's really a benchmark for the entire market. So you're not taking so much of a risk in the sense of investing in an individual stock where you could possibly go to zero. All right, and you got to remember that. You're when investing, if you have a strategy, you're really not ever going to go to zero, especially like if you're investing in index, and that's why they're particularly my favorite. You're never going to go to zero. The reason why is because, like I said, you're always going to own those top 500 companies, and there's always going to be a top 500 companies. And if there wasn't a top 500 companies, we have much worse things to worry about than money. Because think about it. In order for you to go to zero owning the S&P 500, the top 500 companies and the rest of the market would have to go out of business. If at that point every business in the market went out of business, money would be worthless. You have to consider that. So the point I'm trying to get to with this is you have to consider the likelihood of that happening. It's very unlikely. The likelihood, what is most likely in this situation, is that what's happening in the market is temporary. It's temporary because eventually this virus is going to taper off. In fact, it's already tapering off in China. It did peak, but now the new cases are coming down. But what's happening is you're seeing this virus spread across these countries into Europe and into America, and they begin to peak. but at some point they're going to come back down, and that's when we're going to be on that back end. And if you were the one buying when this virus stops peaking and starts coming down, that's when the market's going to start coming back up, and you just took advantage of that. All right, so remember, you just got to keep a cool head. Like I said, the thing that is going to help you keep a cool head is to go in to this incrementally. Don't go all in at, right now, because we're 14% down. Incrementally increase the amount, okay? And again, the other thing that you can help yourself keep a cool head is never invest money that you absolutely need for bills, for your family, for emergencies, things like that. You have to have a cushion for your family, and if you're investing the only cushion that you have, or you're investing the money that you need for a significant purchase in the future, maybe a down payment for a house, maybe your retirement money if you're nearing retirement, you don't want to take a significant amount of risk with that money if it's going to hurt you. But if you have money on the side that you already plan to use to invest, then you can invest that sleeping well at night, knowing that you're still okay if this was to take a 50% loss or a 30% loss. But like I said, that shouldn't happen if you invest incrementally on the way down. So make sure you guys are doing that. Again, I wasn't planning on talking about this. I actually had a whole different subject I was going to talk about this week, but I thought this was really important to get out there, because I know there's a lot of worried people about this coronavirus and what to do in the stock market, so I hope this helps. And lastly, I just want to let you guys know that, I'm already doing that. What I've told you, the advice I've given you, I'm already tipping my portfolio. I had a mixture of bonds, gold, and stocks, equities in there, and I've been currently tipping my portfolio more towards the stocks. All right, and if this market begins to go down even further, I'm gonna tip it even further, because buy low, sell high, right? All right, thanks again for stopping by. Don't rest until you invest, and I will have another video out next week, and see ya.